Brian Beaulieu, CEO, Chief Economist of ITR Economics. Thank you for joining us for the September 22nd issue of FedWatch. The Fed met earlier this week, and interestingly enough, they decided to hold interest rates flat. The street wasn't surprised, the street being Wall Street. They had a 97% probability on the day before that they weren't going to be changing rates. I'm a little surprised because the inflation data, as we talked about, wasn't all that great. And I expected the Fed to be more aggressive, but I'm pleased they didn't, and so should you. They certainly left the door wide open for 2020 November, rather raising rates one more time in 2023. Again, we'll see what they ultimately decide to do. We're going to get some more data, obviously, over the course of the rest of September and October before they meet. So maybe they'll change their minds. There was a subtle change in their messaging in that they, we call it the dot projections. They assemble their expectations of where the Fed funds rate is going to go over the course of 24 and 25. And they didn't have those rates dropping quite as fast as they did earlier in earlier meetings, suggesting that they really believe that they are going to be able to pull off a soft landing. And that's really what I wanted to address here today. There's two reasons why we don't think that that is accurate. In this first chart, we're comparing gross private investment, domestic investment, to GDP. And you can see that the private investment trend is clearly moving downward. And if it moves down just a little bit, you see a bend in that GDP ability to rise. And that's pretty much what you saw in 2000, 2001. Remember, that's one of the paradigms we have for the 2024 recession. Or you can see that it bends down even more significantly, and you get a more significant bend in GDP. And we have GDP not quite as benign as it was in 2000, 2001, going down in the first and the third quarters of next year. So it's consistent with what we see going on in gross private domestic investment. The next chart that you're about to look at is comparing non-defense capital goods new orders to corporate profitability on a rate of change basis. And corporate profits, and these are non-financial corporate profits, so we're excluding all the pain in the banking industry, are running 4.5% below year-ago levels. And you can see by the lead time noted on the chart that gives us some clear visibility into what to expect for capital goods new orders. And that is, phase D is very probable when you look at how these two trend lines relate. And I'm not sure that the Fed's going to see this in time for their November, but that's where we are on track for 2024. From our perspective, it's not going to be a soft landing. It's going to be a hard landing, and therefore the Fed will likely be responding with lower interest rates. They may hold them flat, but the noise that they're making, at least with the September releases, they're showing, I think, greater sensitivity, if you read between the lines, than they have shown before in terms of the softening. And that subtlety could simply be a changing of the Fed presidents that we have talked about before, the ones that sit on the OMC. So we shall see. But takeaway here is glad they didn't drop. They kept those interest rates from going up. Wish they had dropped them, but I think that's still ahead. We don't think they're right in terms of a soft landing for the economy, as evidenced by the two charts that we just looked at. And I know people are beginning to wonder, well, it hasn't happened by now. The recession hasn't happened by now. Maybe it's not going to. Things take time, particularly when it's not a sharp falling off. It's not like this economy is going to hit a brick wall. We're seeing a slow erosion underneath the underpinnings of the cyclical rising trend. We're on track for that softness in 2024, which means the Fed should be lowering interest rates, which gives us a fighting chance for seeing that recovery on time in 2025. We'll see you next week. Thank you for watching this edition of FedWatch.